So in this final video, we're going to actually create the closing entries, and I just wanted to point out a fairly quick and important thing that we need to realize. Closing entries, you only need to do 4 steps. You don't have to worry about anything else for 4 steps. And the steps are: 1. Close revenue to income summary. An income summary is just a special account that we only use to close entries. 2. Second thing you're gonna do is close expenses to income summary. If you're with me still, you're halfway there. 3. You have to close income summary to capital. And last but not least is 4. Close drawings to capital. Those are the only 4 things that's going to happen in this account now. The only 4 things I'm going to do right now. Close revenue to income summary, close expenses to income summary. We're going to close income summary to capital and close drawings to capital. So let's go ahead and see what that actually means. So as you can see here, we have things that are expenses and revenue that are what we call temporary accounts. And temporary accounts, as we mentioned before, are these accounts that must be closed to capital because these accounts only live for a one accounting period. So think about this as if you needed to zero out all of these accounts. You need to zero out this $600, this $600, this $300, this $400, this $1,000, this $50, and this $500, and you have to convert them all to only one account. This is our special account, capital. So all that money needs to go to capital. That's it. But in order for us to be able to do that, we actually have to create another guy down here. And to that other guy, we're going to actually call it income summary. So I'm just going to take this one here, and I'm going to paste it here. I'm going to put in income summary. And I'm going to show you what we have to do in order for us to do that. So before we continue, we could use our friend here, the worksheet, to help us figure out what accounts are the ones that we have to close out. And in order for us to do that is, we're going to have to go ahead and fill out these 2 areas in income statement and balance sheet. And what we're going to do is we're going to take all this, and we're going to take all this, and we're going to put it in either one of this. They cannot be in both. They're either going to be in the income statement or the balance sheet. Income statement or balance sheet. And we could figure out whether they have to be in the income statement or balance sheet just by the name. So that's something that we're going to have to just learn as we go. So we know, and usually it's fairly easy because we know that the first accounts that we had here were the balance sheet accounts, so cash, accounts receivable, office supply, security, and stuff like that. They are actually assets, and assets go in the balance sheet. So this ones here, we know that we can just go ahead and copy and paste to the balance sheet. So this ones go to the balance sheet. Let's just make this a tiny bit bigger. Then we actually know that accounts payable, yes, balance sheet. Notes payable, yep, balance sheet. Capital, balance sheet. And drawings, yep, balance sheet. So all this for our balance sheet. So we paste it right there. Not the revenue, not the child care revenue. That guy's not there. But then we all know that revenue and expenses are all. If it says revenue or expense, is income statement. So we put it in the income statement. and then yep, revenue, an expense, so we put it there. Accumulated depreciation furniture. This is actually part of the balance sheet, because this is a contra asset account that affects the balance sheet. So we're going to go here, and we're going to go here. So again, each of these lines in the adjusted trial balance needs to go either here or here, and that's what we just accomplished here. We put them wherever they have to go. If you're sure where they have to go, just think about it, whether they have to be in the balance sheet or the income statement in the report, and you just put it there. Often, revenues and expenses are the only things that are going to go into the income statement. Everything else is going to go to the balance sheet. So if you remember, revenue and expense go to the income statement. Everything else goes to the balance sheet is something that's probably going to help you out. Alright, so we have gotten the information here. Now we have to do the same thing we were doing before. We have to zero them out. So here, if we zero them out, we should be equal. So we have here 2300, and here we have it's not equal actually. It's only $600. If it's only $600, that means that we are not equal. So what we have to do to be equal is we have to actually add a new friend on our sheet, and this friend is going to be called net income. So net income here, you probably heard this before, net income is either the profit or loss that the business had within an accounting period. So in this case, we had, remember, in the income statement, debits are expenses, revenues are income. So we had $2,300 in expenses, $600 in income. So the difference between the two of them, which is, so in this one here, net income, we actually don't balance out, and we actually have to bring up the difference to make it income, and I'm going to show you why we have to do that. So remember that whatever we do on one side, we have to do it to the other. So here we put this on the credit side for net income and loss of $1,750, and if we do something here in this side on the credit side, we have to do it on the debit side somewhere else, right? So here what we're going to do is we're going to do it on the debit side. So right now we have figured out that if we found somewhere 1750, this would actually be zeroed out. So let's just go ahead and put a line here saying, you know what, this is semi-done. If we go here and add this net loss amount somewhere, then we're going to be real done. So it's going to be this one, and here it's going to be this one and this one. So that's a total of 23 and 23. But you might be asking yourself, is this possible? Well, yeah, this is just the accounting worksheet. So what we have to do is just make sure that both equal on the bottom, right? So pay real good attention to this net income loss line here. We're going to do something else there. And this one we're going to do the same exact thing. We're going to sum them up. We're going to see what's going on here. So we have here, we have in one side 23 to 250, and the other side we want 21,500. So we're like, again, something's going on here. It's not quite right. It's not together. So what's the amount of money that we need to put in one side or the other to make it right? So we're going to go equal this side minus this side. Oh, 750, right? So keep close attention to this number here to see what we're going to do with the closing entry. So this number's here, all this here is going to help us to realize if what we're doing with the closing entries are right or not. So in this case, we have taken care of our accounts. And what we have to do is just make sure that they're all equal here in the bottom, and that is what the net income does here in this guy here. Alright, so let's use this guy here to help us with the income summary. So the first thing that we got to do in the income summary is just like our example required, is close revenue to income summary. So we actually going to go to our journal. We're going to put in here closing entries. Again, these are transactions like every other transaction. These are nothing else. So on 1/31st, this is a real transaction. We have to close. So the first thing we're going to do is we're going to close these revenue to income summary. Remember that's the first thing we're going to do. So in order for us to close revenue to income summary, is we have to find a way of zeroing out revenue. So our revenue is 600. What will you have to do in order for you to be able to zero out $600? In order for you to do that, you have to find out a way of how to debit $600 here, right? So what we're going to do is we're going to debit $600. So this is a closing entry here. We debit $600, and this is what we're going to put in here. Debit $600. And we're going to put here child care service revenue. Again, we're just following the rule. We're closing out child care's revenues to income summary. So in order for us to have this equal, we're going to have to credit $600 somewhere else, right? And that's going to be income summary. So here in income summary, we're going to put 131,600. Be mindful that we have just created a T account that we added the information, and we just created a closing entry that actually added this information too. Then we're just going to specify to close revenue to income summary. So far we have done a closing entry that allows us to put a credit side to income summary. So the next thing that we are going to do is we're going to create another sheet, another entry where we do 1/31/2013, and we close expenses to income summary. So that's the next step. So here we're gonna go and close expenses to income summary. So the first thing we're gonna do is we figure out how can we take out marketing expense. We have to credit marketing expense for 600. So 131,600. We credited this to make a closing entry. So we're gonna have to credit this expense. So here we know that this place here is for the debit side. So if we're crediting stuff, it makes you, it seems like income summary would be the one debited, right? So we're gonna put income summary. We don't know just how much right now. You can put income summary there, but we know already that we have closed marketing expense, so we're gonna put marketing expense. Let me show you what I've been doing. I've been actually taking this in here and putting it right there. So we're gonna use marketing expense, and on marketing expense we're gonna go ahead and put in $600 to zero it out. So as you can see here, marketing expense has $600. We're going to zero out, we're putting $600. The next one we're going to do is training expense. So training expense again has $300 in debit. We're going to use 131 closing to put $300 here. We also are going to go ahead and put in salaries expense, and it's salaries expense again 131. $400 credit for us to be able to close it out. You can see what I'm doing. I'm just closing out accounts by just doing the exact opposite that they have on the line, or the exact opposite balance that they have on that line. 131. 50. So our rule is we're going to close out expenses. So here are all the expenses that we're going to close out. 1, 2, 3, 4, 5. Check what we're going to do. So we have marketing expense 600. We're going to credit 600 because marketing expense has a debit account, and the account that we just posted is a credit for 600. And we're going to do the same thing for all the other ones. So training expense had a balance of $300, so we're going to credit $300. Salaries expense had a balance of $400, so we're going to credit $400 to get rid of that. Then we have rent expense. That rent expense had a debit of $1,000, so we're going to credit $1,000 in this end here to close that account out. Then we have depreciation expense, and depreciation expense had $50, so we're going to put $50 here to close out of that account. So we have marketing expense, training expense, salaries expense, rent expense, and depreciation expense. If we go and add all this, that's pretty much what the income summary is going to be taken away from. So we could just add 600 plus 300 plus 400 plus 1000 plus 50, and we know that we have to actually debit $2,350 from the income summary. And remember, this income summary is a special account only to close accounts, and this is to close out expenses to income summary. This is exactly what we just did here. So in here we have to just post a debit of $2,350. So income summary 1/31st, debit of $2,350. So if we subtract $2,350 minus 600, the balance on this account is going to be $1,750. So that's the transaction that we're going to do in the income summary here to close out account. So we no longer have this account or any of these accounts. These accounts have been already gone and dealt with. The only thing we have available is now this income summary account that has been taken care of everybody else. So income summary is the one that says, don't worry, be happy, that will take care of everybody else. Just give me your money and we'll put it in one account. So we have $17.50, a debit balance of $17.50 on the income summary. Here we already dealt with number 2. So we have here number 2. Now number 3, the number 3 thing that we have to do is close income summary to capital. So again, these are transactions that are on our T account. So for the next transaction that they want us to do is they want us to close income summary to capital. So we closed this 6 already. We have to close income summary to capital. And if income summary has a debit side of $17.50, you have to credit $17.50 to get rid of it. So if we credit here $17.50, we're going to have to debit here $17.50. So the two transactions that we just did was this one and this one. We credited $17.50 to income summary because we had a balance here of $17.50, and we debited to capital $17.50, which is actually a decrease in capital, meaning we lost money this year. So this period. So in here on the ledger, again, these are transactions that are posted like any other transactions. We're going to put in on number 3, we're going to close out to capital. We're going to put in capital as a debit, so we're going to do capital 131st, capital 1750, and then we're going to do income summary 1750, and this is going to be to close income summary to capital. So now we have no more income summary account, and so here is to close income summary to capital, and as you saw on the sheet, that capital income summary, those were the accounts that affected here, that affected this areas here, this to here. Now we have one more rule to do. We have to close drawings to capital. So we go back and see what drawings has and what we need to do to accomplish that. So we have drawings with 500. So in order for us to get rid of drawings, we have to actually credit $500. So we're going to do 131 500, and if we credit 131 500, we have to debit 131 500 here. We're just doing the transactions that we need to do in order for us to be able to be doing 2 transactions at the same time. So these 2 go together, and this automatically closes this ones around. So we're going to see here, we're going to go back to the journal entry. We're going to put our 4th closing mandate. Again, these are not things that you have to think about. These are just things that you do exactly what they told you to do. So 131, we're going to debit capital again. So we're going to do capital 500, and we're going to credit drawings to close out drawings to capital, and we're just going to put it into close in drawings to capital. So we have essentially completed our 4 closing entries, and these 4 closing entries, what they allowed us to do was, again, just take this 4 people, these accounts here that need to be closed because they're temporary, and they allowed us to zero it out. So if you see here, if we add each side together, one side is going to equal another, so you don't have to actually worry about any of these. These are all closed out, so we can actually just, you know, find some type of shape that is like an X. Come on, X, where are you? Okay, there's no X, but you get the thing, and we know that this is already zero it out. That's what we accomplish here. We zero out the transactions. Now that we have zeroed out these transactions, we only stay with capital, and capital has a balance of, let me just check here, it's going to be sum and we have a beginning balance here too, 10,000. So capital has actually a ending balance of 7,750, because these are the transactions that affected capital. So now what we have to do is we have to create a income statement and balance sheet from these accounts here. But we actually have this already here, because what we gotta do is we have to put in the income statement, we have to put revenues and expenses, and on the balance sheet we actually have to just take this one and close it out to this one, which we did already. So we could do actually a post-closing balance sheet by just adding up whatever amount is here. So here we have a debit of 1378. All this stay the same. Here we have a debit of 100. So we just have to tally up the ending balance of these accounts, and that's it. We have done the closing entries.